Well, good morning, everyone. Kiwi looks to have put in a, I would say, provisional bottom at 55.70, with the Kiwi grinding higher towards the 58 handle. A double top, I would say, could form here. Very strong resistance level that, if we do break, indeed is going to improve the odds of further continuation to the upside, and of course support the idea that I'm going to explain here. As also a weaker dollar and a slightly more hawkish RBNZ support that move, right? So on the 4-hour chart, we are looking at prices pushing up, and the RSI, though, showing quite often divergence here, right? That doesn't necessarily mean that the divergence is done, okay? Because I see a little bit more upside, to be honest. And also the 58 handle is a magnet zone, so it probably attract more orders, if that makes sense. But anyway, all of this suggests that the latest leg higher is likely, a fifth wave to the upside, and would also complete an impulse. Typically, how it works is you see an impulse move in 5 waves. So I would be looking for something like this. Where we at? There we go. Let's use this. We'll be looking for something like this. Strong resistance, highly likely a reaction down to wave 2, or perhaps lower down, 56.90. We would want that to hold, and then further continuation to the upside. That's the basic idea. But let's just also look at this fundamentally. First, the backdrop is supportive. The RBNZ has cut 25 basis points, indeed, though last time, but they signal that the easing cycle is probably over, okay? And the other positive event is the new governor, Breman. She is interpreted as a hawkish governor. So this sort of handover in general is interpreted as hawkish. That's why we saw this reaction of that bottom. Okay. Now on the other side, we do have, of course, the Fed markets are pricing an 85-90% chance of a cut in December, and that also is supported by recent data in the US. They have been quite soft this week already. So dollar is under pressure. That also supports Kiwi upside. Now, technically, if the price does indeed go higher, right? So again, I'll do it one more time. We would be looking for buys. We'll be looking to buy the dip, to be fair. So we would hypothetically, if prices get up here, enter close to the 50%. If prices get there, of course, you can do, a pyramid sort of way of entering, if that is working out for you. Entering at 38 with a third of your trade, 50%, a third of your trade, and 61.8, another third of your trade for a complete position. For example, if you had one lot, 0.33, 0.33, 0.33. And that kind of gets you in the trade in case 38 is the pullback bottom, if that makes sense. But anyway, the idea would be to just, let's say, 50%. First target would be the top. Our stop will be below the 78.6. And then we'll be looking, when prices get here and break out, to move our stop to break even, move our target to the next level up, which is the 59, 0.59. I would even just say a little bit lower, 0.5850 initially, which is a very strong support as well. And then once we exit the channel, because it's also important contextually, when we will be looking to trail that move higher up, okay, just trail it, put it like 50 pips down or something. 60 is not the ultimate target, but at a very strong level that we could see essentially being taken out if we do break the channel. But if we do break the channel, there is also high likelihood that we're going to go and revisit that high, the 61.20, and more of a swing trade sort of position, even, I would say. That would take a few months, right? Now, On the other side, the dip might be too deep to buy. So in this case, equally, of course, if we do see this taking place now, just to make that parenthesis, we can use the same approach. I do see this RSI moving a little bit higher anyway. I want this to get to overbought to start looking at this a bit more favorably, if that makes sense. But it's not always necessarily a case that we are going to go and get attracted by the 58, like, sucked in, or the fifth wave might just be in now. So we could essentially see that taking place now. Either way, if we do cross the 50, below the 50, and lose the 61.8, this will come at a critical timing, okay? Whether we are placing our top over here or we're going to go higher up. Because essentially what happens is that it comes at a point where it could also lose the previous channel bottom, right? And this would expose not just the previous low, but lower territories, because it would eventually mean that we could go and revisit that previous low. Why? Because we have corrected quite a bit in the longer term, okay? Already, we have come down to below the 78.6 Fibonacci retracement, right? So essentially, between the 78 and the 100, there is the 90% and the 88.6 that we could see them acting as supports. But the idea here is that if we do lose that low, then we'll be looking for short positions. But this trade is probably going to come at a much later stage, if that makes sense. So we'll be looking to enter the 78.6 perhaps, or they've been the previous low. But if you enter the 78.6, then we'll be looking for the breakout and potential correction, okay? Either at the 100 or the 78.6, because you don't want to be too, there is also the case where you can just enter more aggressively at the break of the 78.6, but then you're risking to be you're facing the double bottom formation here. A strong pattern, I would say, indeed. But if you're just a short-term trader, then that could also work, okay? So traders watching Kiwi should focus on whether the 5680, 5660 holds when we have indeed a correction, a pullback. And as long as the zone is respected, dips are favored for medium-term longs, aligned with more supportive, of course, RBNZ stance and the softening of the US dollar.